Good evening. Indian stock indices ended modestly lower today at the end of a tepid F&O expiry. The NSE Nifty closed below the 5,650 mark while the BSE Sensex managed to end above the 18,550 level. After staying in a narrow trading range for the first half, the frontline equity indices slipped in the late afternoon trade as participants adjusted their outstanding position in the F&O segment before the expiry of the current month's contract. Today's decline was seen despite positive cues from the Asian indices and European equity markets. The BSE Sensex and the NSE Nifty ended near the day's low, while the broader indices held on to slender gains. FMCG and consumer durable indices were the top leaders, followed by capital goods. On the other hand, oil and gas and IT indices were the biggest laggards. SAIL, Sisa Goa, Sterlite Industries, Kane India, ONGC, Hero MotoCorp, BAIL, Reliance Industries and Infosys were among the major losers on the Sensex and Nifty. While Tata Power, L&T, HCL Tech, Hindustan Unilever, DLF, ACC and Bajaj Auto were among the major gainers. The India VIX on the NSE was down by 0.35% to close at 16.91. In global action, Chinese stocks surged to lead other Asian indices higher due to media reports that the country's central bank has injected a record amount of liquidity into the banking system. China's Shanghai Composite jumped by 2.5%, while the Hang Seng in Hong Kong was up by more than 1%. Elsewhere in Asia, main indices in Australia, South Korea and Japan rose by 0.5% each. European stock indices recovered from the previous session's steep losses as the investors awaited Spain's presentation of its 2013 budget and economic reforms. The Stoxx Europe 600 index advanced by 0.5% after having tumbled 1.8% on Wednesday on concerns over Spain and Greece. The FTSE index in UK was up by 0.3%, DAX in Germany was up by 0.5% and the CAC index in France rose 0.7%. Notwithstanding the resilience shown by the Indian markets lately, it remains vulnerable to a small correction following a 2-month rally fueled by government's renewed reforms push, strong FII inflows and monetary easing by leading global central banks. Further, most of the macroeconomic headwinds that have undermined the stock market in the past several months remain in place. Inflation remains elevated, interest rates are yet to drop meaningfully, fiscal deficit is likely to overshoot FY13 estimate, exports are subdued, the rupee remains fragile, investment is depressed and consumer sentiment too is muted. Globally too, problems persist with regard to Eurozone debt crisis due to fears that the Spain is likely to be the next regional nation to seek a full bailout. Greece is struggling to convince international lenders about its seriousness in dealing with spiraling budget deficit. The US is likely to face challenges next year when automatic spending cuts kick in, while China too is under tremendous pressure. Against this backdrop, it looks difficult for stocks to rise too high from current levels. Having said that, the undertone may remain positive due to signs that the government is finally waking up to the reality that implementing key economic reforms is crucial to reviving growth. At best, the main indices can be range-bound in the near term. Investors will also consider next month's corporate earnings and follow-up policy action from the government before resuming their buying spree of Indian shares. Thank you. Wish you have a great evening ahead.